The IPO market now seems to be red hot, with almost $350 billion raised in initial public offerings in the first half of the year. With us now, Eric Vishria, partner at Benchmark Capital. Eric's first investment at Benchmark was Confluent, which of course just went public last week. Eric, thanks so much for joining us. We had Jay on the show last week. I know it's a big deal for you. And interestingly, you invested in this company like a month after joining Benchmark, and I know there's this sort of traditional window where you're not supposed to make an investment for the first 6 months, but you had conviction. What gave you that conviction?
I think we are trying to find the handful of really special companies where you have a kind of combination of an incredible entrepreneur, a big idea, and an emerging market. And at Confluent, that came together. It wasn't even called Confluent at the time. It didn't have a name. But we were really fortunate to get introduced really early and had that feeling. And it's been quite a journey from 3 people to 1,500 plus in less than 7 years.
What do you think about the technology? Because obviously, in part, their growth has been attributed to the pandemic, being this sort of central nervous system for the acceleration of all of this technology that people are using. But is that going to continue post-pandemic when life returns to so-called normal?
I actually don't think that the pandemic has been very important in terms of making companies realize generally that digital is the competitive frontier. That's where they're going to win or lose customers. That's where they're going to win or grow or decline in revenue. But for Confluent and a lot of the other software infrastructure companies and those, I think the general move to the cloud and overall digitalization has happened over a decade plus. It's not something that is specific, and I think it'll continue for the years to come. I don't think it has any signs of slowing.
Now, your partner, Bill Gurley, has been on the show many times, pushing the value of direct listings over traditional IPOs. Other benchmark companies like Asana did direct listings instead. Why go the traditional IPO route? And how much debate was there around that, around your table?
Well, I think, Asana is a great example of a company that is in the portfolio that didn't need to raise capital, primary capital, so put money on their balance sheet. And so direct listing is definitely a better approach in that case. And I think we're going to see more and more of those, as we've seen several this year. In the case of Confluent, we wanted to raise primary capital, and so the direct listing wasn't an option, unfortunately. But I think that'll continue as soon as we can get through the regulatory hurdles such that companies can direct list and raise primary capital. I think that'll unleash a torrent, and I think that'll become the default path in the future.
The last 6 months have certainly been active on IPOs. Do you see systemic change in the IPO market, positive change in the IPO market? Because the complaints have been this is an antiquated way to get to the public markets that don't necessarily benefit the people it's supposed to benefit.
I think there has actually been change in the IPO market. Like any market, competition tends to unlock possibilities and make everyone put their best foot forward. And so I think the competition from direct listings and even to a lesser extent SPACs has actually kind of made some improvements in the traditional IPO process. Confluent was an example, I think the second example behind DoorDash, of a company that didn't have a green shoe, for example. You see a lot of these IPOs have earlier employee lockup releases, which is beneficial. So you don't have this kind of artificial 6-month cliff, and then all of a sudden, all the insiders can sell. You can kind of stage it out over time, which I think benefits everybody, including the public market investors. So I think there have been some meaningful steps forward. Having said that, I think there's still quite a bit of progress to be made. And I think a direct listing ultimately is the path and the place that will end up, hopefully.
Interesting. Robinhood filed to go public today officially. Bill has also been pretty outspoken about Robinhood, saying they're glorifying speculation. The SEC should ban payment for order flow. When you look at a company like Robinhood, what do you think about the legitimacy of their business model?
I haven't had the chance. I saw the news that the S1 came out or flipped today, but I haven't had a chance to read it. Payment for order flow is controversial, but Obviously, a lot of companies, not just Robinhood, use that as their business model. So that seems to be a regulatory question, I guess, more than anything else, and certainly outside my area of expertise. I
Now,
don't think
you
it
are one
impacts
of a newer
the company's
generation of
prospects.
Okay. Okay. You're one of a newer generation of Benchmark's partners, and we're seeing the sort of more traditional venture capital industry evolve. We're obviously coming out of a pandemic. The world is going through another massive transformation. How do you expect the firm to evolve, to respond to that? And where is Benchmark, and where are you going to be placing your bets?
I think it's one of the really cool things about the Benchmark partnership. We tend to be about 5 active partners at any given time, and for the last, say, 26 years since the founding of the firm, that's been an evolution, and it's always something where we have some newer partners and some partners retiring. The thing that we have stayed true to is we love finding this handful of really special companies, really special opportunities every year. Each one of us makes 1 to 2 investments a year. And we think of them as commitments. They're decade-long commitments. They're not bets, they're commitments. And so we're making 1 to 2 of those a year. They're well thought out. And then we hopefully are able to work with those companies for a decade plus, like in the case of Asana, like in the case of Confluent, and see them all the way through to massive success and beyond. And so I think that part of the model is really going to stay true. Of course, valuations move up, the dynamics, the industry, and where the white space is for new companies changes over time. But the core model, we stay true to that, and we love it.